Regional banks have been on a roller coaster lately, calling into question the stability of the financial system. Joining us now with more and where he's finding opportunities in this market is Vance Barse, wealth strategist and founder of Your Dedicated Fiduciary. Well, Vance, great to have you back with us.
Jenna, it is truly a pleasure to be back on the show.
So what are you hearing from clients right now, Vance? I'm sure they have a lot of questions about the banking crisis that's unfolding.
Very much so. Calls are coming in from clients that are very reminiscent of 2008. Because if you turn on the TV or read the newspaper, you're hearing or seeing headlines about one bank after another failing. And these are not just necessarily small banks, right? With what happened with First Republic, that really was the threshold where clients started to call in and they're specifically asking, is this another 2008 scenario? And is my money safe in the banking system? And I explained to them this is largely a product of monetary policy. Clients have already been advised of the record rate increase that the Federal Reserve launched last year. We're now at 5 to 5.25 in just over a year, which is quite extensive with respect to velocity. And they already understand that the rate raise itself and the pace of it is unusual, but the implications of it are now rearing their heads and showing themselves within the banking system. And that is ultimately what is causing the issue with these banks.
So how are you playing duration right now in light of all this, Vance?
We were an early adopter to the T-bill trade, rolling 3 and 6 month T-bills starting in about February of last year. At the time, remember, CPI and other types of inflationary data were on the increase, but we really didn't know the extent to which inflation would evolve. So as a potential hedge, if you will, with respect to the impact that a significant rate raise may have on duration, and of course, bonds and bond funds, we adopted the T-bill trade, and we have actually recently started rolling back into duration. So we explain to clients that there is an inverse relationship between interest rates and par values. And yes, Jenna, I do bust out a picture of a seesaw and explain it to them and show them what happens, generally speaking, to par values when interest rates go down. And while we certainly don't know when the Fed might start to cut, we certainly want to have that duration in the portfolio. So we're looking at great quality. We are looking at certain types of bonds and avoiding some of those sectors that historically have behaved like stocks when we have a credit crunch.
And speaking of stocks, what about equity markets?
We believe that equity markets are largely priced to perfection this year, given the data that we know. We are long-term holders of equities. We don't think that the value trade is necessarily over. So we're being very selective as to where and how we deploy allocations to equities. If rates do, in fact, come down organically or maybe inorganically by way of the Fed cutting later this year, certain sectors within growth do look appealing to us. But of course, we always go back to clients and say, what is your long-term risk objective? What are your long-term investment objectives? And we'll deploy accordingly.
Yeah, and finally, I do want to talk about the Fed, which you mentioned. Do you think that there's any chance left of a soft landing?
I like to believe in rainbows, butterflies, and unicorns. However, that little thing called reality comes a knocking. The data that we're seeing is such that it would suggest we likely have a bit of a hard landing, but who knows? Anything is possible. The Fed could cut just in time and somehow avoid stagflation. I mean, that's one of the big concerns that we have is if the Fed does cut sooner than the bond market is pricing in, or alternatively, if the Fed does not cut like the bond market is pricing in, then what are the implications with respect to equities and fixed income? So we are cautiously optimistic, but we are watching the intra FOMC meeting data just like everybody else. And we're really interested to see how this all unfolds the back half of this year.
Well, any final thoughts you'd like to leave with our viewers, Vance?
If you'd like to follow me on Twitter for my monetary policy insights, I welcome the opportunity and I look forward to being back on the show. Thanks so much for having me on, Jenna.
Thanks so much for joining us, Vance, and thank you to everyone watching. Once again, that was Vance Barse, a wealth strategist and founder of Your Dedicated Fiduciary.